And I've studied that before, and the interest alone is staggering.
It's astounding.
It's astounding, yes, sir. So I'm gonna step aside, El. The floor is
Thank you.
yours, my friend.
Thank you so much, Mr. Brown, and welcome again from a month-long hiatus vacation from your trusty tax reporter, Everett James, nicknamed Ev, from Ev's Tax and Consulting Services. This morning, or we're going to just take a peek, and I can guarantee you that that will certainly interest and alarm most reasonable and thinking Americans. We're going to take a quick peek again at our tax debt and how interest is playing a threatening role in the whole situation. We welcome listener participation and regular questions at our weekly get together every Wednesday morning at 10 a.m. to approximately 11 a.m., give or take a few minutes. My contact number is 951-522-9877. That's 951-522-9877. And for those who are more disposed to use of the internet, which is, not unusual, which is really the case with a large majority of the American population using the internet services and for sending electronic mail. That my mail is evjtax1 at gmail.com. Again, evjtax1 at gmail.com. We will provide a little reward for those who call in their questions and comments. So please make use of this opportunity to participate in this tax knowledge get together every week. For those who do call in, there will be a little bonus for you. And I will be happy to provide a free of charge tax consultation for the past 2023 tax filing year, which, as you all well know, concluded last April 15th. Keep in mind that the that tax returns filed by that date met the required IRS deadline, and keep in mind that not only included just filing your taxes, but it included the date by which your liability has to be paid for those submitting the taxes that they're liable for those submitting the payment by April 15th of 2023 last year. There will be no penalty, but there will be a late penalty for submitting the actual amount of money that has been calculated as your tax due for 2023. The For those who have filed an extension, that extension really ran out October 15th of last year. But if you haven't filed, please attend to this matter immediately, and feel free to contact this program for suggestions on how you just might do that, not only filing, but also paying the required taxes that you are due to the federal government. Okay, this is the subject of this morning is the debt and interest albatross that we have around our necks as taxpayers. Um, and a large part of that albatross is in the interest payments on the national debt itself. They've This is an ever-present weight around our neck and a burden that is draining growth and opportunity. Congress should play a central role in educating the public about this existential threat to our economy, national security, and way of life. The Nonpartisan Congressional Budget Office, CBO, recently reported that the United States will spend $892 billion with a B on interest payments just this year. And that amounts to going up to like about 153%. Unfortunately, since the current administration took office, it's been 153% increase since the current government took over. And, this has reached a situation where, for the first time in our American history, interest payments now exceed what I say, what we spend on national defense. The only thing that is more than what we pay in interest is on Social Security. And it's really amazing, a little shocking that Social Security is the backbone of support. So for so many of our residents in this country, citizens in this country, and yet that program, the Social Security program, is growing by the leaps and bounds. The total national debt is projected to hit $35 trillion with a T, and it's growing at an average of $1 trillion every 4 months. If you can even visualize and even conceive of those kind of figures, but the 35 trillion mark is fast approaching, and just figure $1 trillion every 4 months is the growth pattern of our national debt. So Washington does have to address this interest albatross. If we don't, we're going to find ourselves forcing the next generation, to be ridden with debt, decline, and diminished activities. And that's just an incredible situation. The It's interesting that one of the main things that our founders have put in the record. One was from Thomas Jefferson, and he wrote at the time he lived that it is incumbent on every generation to pay its own debts as it goes, not pass it on to their grandchildren. It is incumbent that the generation has to pay for its own debts, as it goes. The very relevant tax fight that is coming up next year, it does present a chance to help the working class families. There's going to be an epic showdown over tax policies. A lot of the provisions of the Republicans' 2017 tax law are all set to expire at the end of 2025. And as a result, at the end of 2025, most people's taxes will certainly shoot up if Congress does not step in and pass legislation and pass laws. that will provide some kind of a working fix for our national debt overall. The One of the things is that there's been a lot of special programs to help the working class meet their expenses, and a lot of these benefits have gone to non working people. Unfortunately, yeah, and in some cases, even made the a lot of the tax um, credits fully refundable. Now, when you have a situation where they're going to get a fully refundable tax credits, that destroys the work incentive built into the programs, particularly the child tax credit. The Lawmakers should resist that proposal and be skeptical of smaller steps in that direction, such as giving out the child tax credit based on work in either of the past 2 years, rather than just the year for which the taxes are being filed. So, one of the things that I would say is a negative here is basing that child tax credit on work on either, one of the two past years, instead of just the year for which the taxes are being filed. Now, the other major tax credit has been the earned EITC, the Earned Income Tax Credit. Wow, that should only be given to those who work, and it should just be limited to folks who um, are parents, as opposed to non-parents. Non-parents can still you can still receive a small earned income tax credit if you're not a parent. But unlike the child tax credit, the earned income tax credit sends out checks to workers in excess of the taxes that they pay, and it phases out as the parents rise to the middle class, of instead of only for the wealthiest taxpayers. Now, the structure does make a powerful incentive to work, and provides a strong focus support system for working class families. But there is a huge problem with the earned income tax credit. It brutally punishes working parents for being married. The So it's with that background, it's good to highlight what is happening to um, the major um, expenditure in our budget, which is Social Security. The Social Security right now is in worse shape than it has looked, and the rot runs a lot deeper than we thought. In May, the public received another huge update from the Social Security, confirming that our Social Security Trust Fund will be insolvent in 9 years. That is approximately 1933. But what has been buried in the data coming forward is that the total cost of the Social Security insolvency has ballooned up to 615 trillion. That's trillion with a T, in nominal dollars. That's nearly 100 trillion increase in debt from 3 years ago. We can't really afford to just wait and see and how much higher that number will go. The $1,615 trillion accounts for the cost of paying benefits and interest on the debt the United States would accrue if we allow Social Security to go insolvent and deficit spend just to keep it afloat over the next 75 years. This sort of underscores the severity of the problem and the need to stop, collectively burying our heads in the sand. When the Social Security Trust Fund is depleted in 9 years, current law dictates that there would have to be like about a 21% across the board cut for all current and future retirees. Can you imagine for most of us who are listening in, can you imagine what a 21% cut in the Social Security would do to our amount, due to the fund from which we pay all of our monthly bills? Wow. Um, Congress can cut this, this Congress can avoid this deficit spending, but it should pursue a strategy to make the program sustainable and fair. We need a comprehensive plan that avoids massive benefit cuts or tax hikes and avoids putting us on a road toward a 615 trillion in additional debt. Um, there is a group, a working group in the Senate that is working on big ideas to create possibly a new fund that's separate and independent of the Social Security Trust Fund. This new fund would invest at 1.5 trillion in financial markets, just like a normal pension fund would do, and hold it and all dividends in escrow for nearly 75 years, assuming historically average marker returns. This big idea covers about 2/3 of the Social Security shortfall, including the borrowing cost. The remainder could be possibly addressed without raising taxes on seniors or cutting back on their benefits. Filing, fixing and Social Security is a math problem, but I think the bigger problem is the political problem. Willingness to tackle this problem. The longer we wait, the less favorable the math becomes, and the more painful this whole thing is going to be to fix. So this just isn't hyperbole. We've been seeing the effects in real time. Investing now in this kind of a separate fund could save our country and taxpayers a great deal, and save taxpayers trillions down the line. And that is truly amazing. So, would this program welcomes your comments on this growing issue. Not only just the tragedy of having to pass all of this debt on to our grandchildren. And wait a minute, I thought, particularly focused on the senior population, I thought that we were supposed to be leaving, at least that's what we were always taught as youngsters, leaving some kind of inheritance for those who survive us, principally our grandchildren, and to instead leave them with this debt to pay on, which would be added on to whatever debt is accumulated just from them drawing from drawing their own Social Security benefits. So, with that, we remind you that we invite your questions and your comments on this massive debt issue that we are witness to. Okay, we would like to, the program would like to invite your comments in this again. My phone number is 951-522-9877, and by email, evjtax1@gmail.com. And as I've mentioned in past program, whatever questions you have, we will make every effort to respond with a answer in the following week's program. So please um, include your comments in our ongoing program file. Okay, I'd like to just to use a major part of this program to provide updates from IRS, largely dealing with the technicalities, some technicalities which are going to affect large groups of taxpaying public, um, as well as information about some of the improvements that the Internal Revenue Service has made in their operations, which is going to save you a great deal of time on the telephone and hopefully save you significant amounts of money from not having to pay penalties. Okay. The first thing is from regarding the individual retirement accounts. This past season, this reporter and tax preparer have certainly noticed the literally huge number of workers, full-time and part-time workers, who have drawn large amounts of money from their IRA savings and pension plans to just help make ends meet. And unfortunately, a number of taxpayers have failed to report the often very large IRA distributions. And this applies not only to just IRAs, but also to 401k pension holders. Failing to report these large distributions, that can draw a lot of unwanted IRS attention. But IRS does have a program in its automated underreporting program. It matches data on information returns, such as 1099-Rs. They match that amount with income amounts reported on individual tax returns from you. If there's a significant mismatch, wow, the agency will alert the taxpayer to the issue by sending out the computer-generated CP 2000 notices, and there are a number of different categories of the CP 2000 notices, but they're all part of the overall 2000 taxpayer notices that go out. Now, in a recent case, a taxpayer had failed to report an IRA distribution, and it was like just over $122,000. And it was actually shown on a 1099-R form. Well, they did hear from IRS, went to court, and the court agreed that the payout is taxable because that's just part of the tax law. And I might add that because of the large number of similar situations with other taxpayers, the IRS, has provided a great deal of information on reporting these distributions, and in some very, very unusual situations, there might be a chance to at least cut back on the amount of penalties that could be assessed by IRS. But yeah, let me assure you that trying to go to court is not going to be a winning path for anybody who is in any kind of contest with IRS, because the record, the court findings have almost always unilaterally agreed with the IRS positions, and the taxpayer winds up still owing the same amount of money. Now there is a penalty, some penalty relief. One thing we can say right at the outset of this is that a little luck sometimes goes a long way in getting out of the penalty or getting it drastically reduced. They, in the case of the man that I just mentioned who failed to report that 122,000 in an IRA distribution, IRS assessed a 20% substantial understatement penalty. The taxpayer assessed that he claimed that they didn't give him prior written that IRS didn't actually manage to get a written supervisory approval for the fine. IRS came back and argued that prior approval is not required for penalties that are automatically calculated without human review through its automated underreporting program. Now there is one escape hatch, however, that there is a requirement that human review and thus supervisory approval of this kind of fine are required in instances where a taxpayer has responded to a computer-generated letter proposing a penalty. So again, respond to all notices from IRS. This situation included anything from IRS that is proposing a penalty. Believe me, when they say proposing without any kind of response from you, that is a done deal. But in this particular tax court situation, they determined that the taxpayer might have submitted such a response. So what did it do? It gave the taxpayer a victory on the penalty issue. I'm sure that is not the situation in most of these tax challenges from taxpayers. Here's a reminder for taxpayers who filed a delinquent return or paid taxes late. You may qualify for a penalty waiver under IRS's first-time abatement policy. IRS will okay a waiver of the late filing and or late payment penalty for filers who pay or arrange to pay the tax due. That's the first one, and that have been tax compliant for the past 3 years. So if you meet those two conditions, there is a possibility that you may get a waiver on that on the penalties. Again, you have already taken action, to make payment of the past due taxes, and you. In addition to that, have been compliant with the tax law regarding filing and paying for the past 3 years. Okay. The question might come up, when must IRS file suit to recover an erroneous refund paid to a taxpayer? You know, that has, this situation has occurred a number of times, particularly during the COVID years, when there were so many refunds associated with COVID conditions. Now, in a recent case, IRS made a clinical error, and they mailed a uh, a refund check to a taxpayer for $491,104. The check got mailed to the taxpayer back in May of 2017, and when the refund should have only been 3,463. So I mean, it was only a $487,000 sum over or above the amount that should have been spent. Well, the taxpayer cashed the check in May of 2017. He went ahead and cashed that check, and the IRS filed suit to recover the funds in March of 2020. And as under the federal statute, IRS must file suit within 2 years after paying the refund. Now, for this purpose, the taxpayer claimed that a refund is paid by IRS when received by the taxpayer. That's when the taxpayer felt that that was when the beginning of this 2 year the filing requirement starts. However, IRS argued in court that that the refund was considered paid on the date the check clears the bank, and that just from common sense, it would appear as though that would be the ruling condition. And as you might have, you know, um, might have forecast, the appeals court agreed with IRS, so the agency complaint is timely, and so the person was held to that. Held to the requirement to return the money. There's been several other federal appeals courts that have addressed this issue, and they all ruled the same way. The um, Just for those of people who uh, are involved in the 501c3 organizations, if the purpose of that 501c tax structure, if the purpose was to offer access or is to offer access to spiritual growth and healing rights through the consumption of a particular substance that it contains a Schedule One drug, and that's under the Controlled Substances Act. If that's the case, um, in a recent case, a district court decided that the group is not organized and operated for tax exempt purposes. Wow. And that was recently affirmed in the Ayahuasca Church of Healing in the District of Columbia Circuit Court. That ayahuasca is IOWASKA, Ayahuasca Church of Healing. So I'd be very, very careful. I was connected with the 501, that particular type of 501c3 exemption. The currently IRS is slowly working on a logjam of employee retention credit fund claims, and the emphasis now is on slowly. The COVID-19 related payroll tax break for firms. It was originally set up to help eligible businesses whose operations were fully or partly halted, during the COVID crisis, or the gross income receipts fell significantly during the height of the pandemic. Employers, had been swamping IRS with these Form 941-X filings seeking refunds, the for prior year employment taxes that they had paid, and any excess refundable employee retention credits. So by the end of May of 2024, IRS had more than 1.3 million unprocessed employee retention claims. Wow. Per IRS, a significant number of those filings were what they call improper, with some and probably many due simply to outright fraud. IRS halted its processing of the ERC refund claims last September of last year, and they cited the need for a detailed review. IRS has completed that review, and they have more bad news for filers. Most of the claims that they reviewed have the potential for errors. Ugh, wow. The IRS says that 10 to 20% of filings are clearly erroneous, and between 60 and 70% show an unacceptable level of risk of error. So, of that overall group, only 10 to 20% are zero risk or low risk. So I guess they break it up in risk categories and then go after the those with the high risk, which were running between 60 and 70% of all of the claims. They've already began that process of reviewing those claims in the third group, and that was provided that the taxpayers filed their 941Xs before September 14th of last year. Now, those who filed claims later will continue to be the subject to the agency's moratorium on processing until the agency announces otherwise. Meanwhile, if you are one of the legitimate um, ERTC filers, um, you're really stuck waiting for your refund. You really don't have much recourse, basically. The IRS, they will have to pay interest when it eventually does dole out the delayed refunds, but that's certainly not going to help businesses that need the money right now. So watch out for those employee retention credit refund claims. By the way, there is some help for employee retention credit filers, for those um, who for those who have filed and have recognized that they may have made a mistake on the original claim that they made, and fess up, you might say, to IRS, recognizing their mistake and indicate a willingness to withdraw the credit request altogether. There is some penalty relief for that population. So keep that in mind. Are you changing? Have you changed jobs mid-year? Well, oftentimes for folks who have two or more employers, if you're in the highly compensated group, and Social Security is taxes withheld from both of your jobs or three jobs or whatever number you may have had. If the total amount of Social Security taxes withheld exceeds the wage base right now, at least for 2024, is 168,600, and if during this year, if you add up all of that all of the Social Security taxes withheld from your two or more employers, if it does exceed that total wage base of 168,600, if it exceeds that wage base of $168,600, you can claim a credit for any excess Social Security tax withheld, and you can claim that on the Schedule 3 of the 1040, which you would file early next year. And that's because each employer that you work for in a year withholds Social Security tax only up to 168,600. But of course, they can't or have no way of knowing just how much Social Security wages you earn at your other job, or how much that amount, how much that tax was. So they wouldn't know that of your other jobs. But if that does apply to you, I would recommend contacting a tax professional to get some assistance on filing a claim in that situation. There is a form, which I'm sorry to say I don't recall exactly the number of that form, but there is a form that can be filed computing just how much Social Security tax was withheld, and if it exceeds that wage amount, that base of 168,600, you would be due a refund of that amount. Okay, the thing that has just recently come up regarding the treaties, tax treaties with other countries. The U.S. and the United States and Russia are suspending most of their income tax treaty. In August of 23 last year, Russia told the United States it wanted to suspend a 30-year-old tax treaty pact, and they cited that for the reason for their desire to suspend that tax treaty was because of our response to their invading Ukraine. Now the U.S. Treasury Department is now reciprocating, and they've announced that it has provided formal notice to Russia to confirm the suspension. So the cessation of that U.S. Russia income tax treaty will continue indefinitely until the two countries decide to reinstate the pact. Folks who buy medicine from abroad can come up with a hefty tax price. The cost is generally not deductible. I say not deductible as a medical expense on Schedule A, and that's because the federal law bars importing many drugs from other countries. So for the same reason, the cost of these medicines just cannot be reimbursed by the health savings accounts or flexible spending arrangements. Now, there's some exceptions to this. For one, you can include the cost of an imported drug in deductible medicals if the drug was imported legally. For example, as announced if it was imported legally, that is, it was announced by the Food and Drug Administration. The second situation is you can also include in your medical deductions the cost if you purchased and used that drug in another country, providing that the drug is legal in that other country and the United States. How has IRS been doing with its services, particularly its phone services, this past filing season? Is it really as good? The IRS says, well, the agency's level of service of 85% or more on its phones this year and in 2023 is touted by IRS as much better when compared with prior years. But what is the level of service? What does that actually measure? That level of service performance doesn't really fully reflect the experience of callers on those lines. And that's according to the IRS's National Taxpayer Advocate. Per IRS, the service routed 10.3 million calls on its account management lines to customer service representatives during the 2024 filing season. And operators answered 9 million of those calls. And that produced a level of service of 88%, which is not too bad. But IRS actually received nearly 40 million calls during this time on all of its lines. So, it routed 10.3 million calls, but that was out of 40 million calls during this time period on all of its lines. The 88% level of service measure actually ignores calls in which the taxpayer disconnected before being placed in a calling queue. And in those situations, the calls were routed for automated responses, or calls routed to non-account management lines, and that was for taxpayer debt payments, etc. So that dropped their efficiency level of the calls. Just moving on for additional updates. There's been such a thing as the Super Bowl of Tax 2025 tax cliff. And this is because back under the Trump administration, he promoted and pushed the 2017 tax reform law. And that was set to end after 2025. And one of the stipulations of all of those increases that were legislated during under the tax law of 2017, they were set up to sunset or end after 2025. When that magical date arrives, which is just next year, folks, the tax law reverts or goes back to the rules that were in effect for 2017. And the only out from that is if taxpayers, the lawmakers act and extend those really beneficial laws that were passed in 2017. So the next president, would definitely have to confront this issue. And of course, he's going to, all of the real action is going to be taking place in the Congress. It'll be a lot easier, of course, to pass big tax changes if after the election is over, that just one party controls the presidency in both houses of Congress. But past history has shown that oftentimes this does not occur. And so that means all that additional compromise is going to be on the drawing board. And there could be divided government come next January. We just don't know for certain. The one possibility occurs if the next president is Donald J. Trump. He does have some ideas when it comes to federal taxes. First and foremost, the Republican candidate wants to make the 2017 tax law changes permanent and to take it further with even lower tax rates for individuals and business taxpayers. The folks who work in the hospitality industry and the restaurant workers, they're going to get a boon if Trump has his way, because he's been pushing the tax be stripped of their required reporting, and so the tips might become tip free. At this point, the Kiplinger tax letter from which I am quoting does not have any details yet on this initiative, but most Republicans quickly have gotten on board, and it has been included in the 2024 Republican GOP platform that was adapted by the Republican National Convention in Milwaukee just recently. And he'd also use that is. Mr. Trump would also use tax incentives and credits to help promote home ownership. That's one area that deserves a entire informational session plus from this broadcaster. On business taxes, Mr. Trump supports dropping the 21% corporate tax rate to 20% or maybe even lower. Some people in the Republican Party are pushing for a 15% tax rate for C corporations, but they are also promoting the desire to have a 10% across the board tariff on imported goods. Now, Mr. Trump has been talking about that possibility for years. Among some of the other business tax ideas that have been floating is eliminating the clean energy credits under the 2021 Biden passed Inflation Reduction Act, allowing businesses to claim research and development deductions in the year incurred rather than amortizing them or rather than deducting them over a 5-year or 15-year period. And folks on the right side of the aisle have been repeatedly called for an end to what has been termed the Johnson Amendment. What is that? The Johnson Amendment? Well, it's been on the statutes for 70 years, 70 plus years, actually. And what it is an amendment that prohibits churches, charities, and other 501c3 exempt organizations from participating or intervening in political campaigns, either for or against a candidate running for office. And I've heard about that Johnson Amendment for many years. And that certainly would have a huge impact on the activities of various churches in filing their 501c3 tax returns. The additional, since we are in the middle of summer, the summer is a prime time for natural disasters, and we're all hearing about the natural disasters in Florida and South Carolina, Georgia, Texas. That is the prime time for natural disasters. Sometimes the tax law can help. Sometimes if you're just only a personal owner as opposed to a business owner, but if your home, business, or personal belongings suffer damage this year in a federally declared disaster, that's a key condition. It has to be a federally declared disaster. You may be able to deduct your losses. And what are federally declared disasters? Well, that's disasters such as hurricanes, tornadoes, floods, wildfire, etc., etc. That is declared a federal disaster area by the president, and use that definition to determine whether or not you might be able to declare a loss if it's declared a federally disaster area. Now, you can deduct the losses to the extent, of course, that you're not reimbursed by insurance. Your loss is equal to the smaller, and keep your eye on the smaller. Your loss is equal to the smaller of the damaged properties adjusted basis or decline in value, less any insurance proceeds that you received or expect to receive. So again, your loss is equal to the smaller of one, the damaged properties adjusted basis or decline, or two, or decline in value, or two, insurance proceeds that you receive or expect to receive in the future. Now, computing the amount of loss to your home or belongings, that can be difficult. Take this tax reporter's experience in mind. Luckily, IRS does have multiple safe harbors to help you with the overall calculation. Also, do not forget that only itemizers, only folks who itemize, can claim a deduction for damage to non-business property. And there's two offsets apply. The loss that you calculated is first has to be reduced by $100. And the second loss is the balance is deductible only to the extent that it actually exceeds 10% of your adjusted gross income. Again, there's two offsets apply. The first one is you have to deduct it by just a flat $100. The second one, you can't. The only amount that you can deduct is only the amount that exceeds 10% of your adjusted gross income. And to do this, you need Form 4684 to calculate your loss and transfer the amount to the Schedule A. So, of course, if you don't itemize, you're not going to be able to deduct loss. There is in the future, hopefully, a bill that just passed the House. It does include some tax relief, but now, unfortunately, it's stalled in the Senate. What is that bill that could make filing for a disaster so much easier? This package would let victims of federally declared disasters take personal losses, even if they don't otherwise itemize on Schedule A of the federal income tax return. They would be able to deduct uninsured personal losses in excess of a $500 threshold. The net loss would be treated as an additional standard deduction for people who do not itemize. The rules for deducting casualty losses on business assets, however, are much more liberal. And for the businesses, you do not have the $100 and the 10% of AGI limits. They just do not apply in this case. And non-itemizers can write off their losses. So keep in mind that if there's been any disasters in your experience, they can be claimed on in 1 of 2 years, on the year that the loss actually took place, as well as the year before that year that the disaster occurred. And again, that's because individuals can opt to take the loss on their return for the disaster year or the year preceding the disaster. Now, if you've already filed your 2023 1040, you can amend it to take the write-off by filing 1040X. And for this purpose, the due date for a 2023 amended return, and I'm sure that may affect many of you, is 6 months after the normal filing date for 2024 returns. Now, for those of you who may suffer or have already suffered a disaster loss this year in early 2024, the amendment date that you have to have it in by is 6 months after the normal, filing date, and that would for 2024 losses, that would translate to October 15th of 2025. For more clarification on this, please feel free to contact this tax reporter. My last just update here for the moment is adopting or planning to adopt a child. Well, you might want to take heed of the adoption credit. It is now taken on up to $16,810 of qualified expenses per eligible child in 2024. And as we go, it's very notable that the adoption industry is growing, and it is certainly being promoted tax-wise because of all of the children who wind up being left or abandoned or no longer cared for by their parents for one reason or another. But but the move to promote and increase the number of adoptees is certainly very socially admirable, and that's why the amount that you can deduct keeps going up. So it has for 2024, you can get it up to 16. The amount of expenses for your adoption, you can write off up to $16,810 per eligible child in 2024, and that includes adoption fees, court costs, legal expenses, travel, meals, and other expenses. Pretty much everything directly related to the legal. So I think with that, we will conclude our program from this vacation returning reporter, Everett James. And have a great week, and we look forward to your comments.
All right. Hey, Ev, thanks so much. Man, a lot of valuable information each and every week. And ladies and gentlemen, I'd like to share this with you. You can check out Ev each and every Thursday on this global